Hey, good morning. Fun week last week. What's happening right now with rates is they have two forces on them that the Fed is supposed to respond to. One is inflation, one is employment. If inflation starts to go up, the Fed will come in and increase their Fed funds rate to tighten up the money supply. If unemployment starts to go up too much, the Fed will try to reduce rates to free up job openings and stuff like that. So, which one do they address? It's kind of like having two kids, from what I understand, and whichever one is misbehaving, you address that one. We have a little bit of this right now going on because we are seeing some cracks in unemployment as well as some inflationary signs tick up. This Friday is the personal consumption expenditures report, PCE. That's expected. People are thinking it's going to come in a little bit hot. And what that's going to do to the mortgage market is it might be a good day to lock your stuff on Thursday and avoid a precipitous uptick in rates, maybe as much as like a quarter percentage point. But I could be completely wrong. But I'm going to hedge, and anything I need to lock, I'm going to lock this week before Friday. Specifically, right now, uh, it's Monday afternoon, late. The 30-year fixed conforming conventional improved just a little bit. That could disappear with no discount, about 6.75%. Boy, FHA, VA, USDA, exactly where they were the past few weeks, in the very low sixes with no discount. You can buy your way into the fives if you need or want to. And that 7-year fixed arm that goes up to uh, several $1 million, depending on the down payment amount, 20% down payment. It's about 1.75 discount will get you into the middle fives still. We'll see if that holds. When rates start to get a little messed up, like I think they might, that stuff tends to become more expensive to the point that you're not going to get into the fives. So we'll see what happens. Maybe nothing, right? Okay, so hey, here's a good one. I know you're all wondering, what is APR? Well, APR stands for annual percentage rate. It's the total cost of borrowing when you factor in title fees, lender fees, everything. And this because I just really wanted to just plant us in the weeds here. The APR calculation, interest plus fees divided by loan amount, divided by the number of days in the loan term, times 365 days, times 100. So maybe now you know why I don't like to talk about APR. Point four here, if a loan has no costs or fees, APR would be equal to the interest rate. Okay, that makes sense. If there's no cost, no fees, no discount, no title fees, nothing, APR would equal the actual interest rate on the loan. So what APR is, it's a representation of the total cost that you're paying relative to the loan amount when you factor in lender fees, title fees, all that good stuff. So the APR tends to be higher than the actual interest rate used to calculate the payment. And I'm glad we could put that to bed. Let's talk about stacking assets, new loan programs that are really cool. Uh, this is for borrowers that have a higher than allowable debt ratio, right? They're making X amount of dollars. We do the income calculation. We're not there. We're over the line. We need more income or another borrower, a non occupant cosigner, or something like that. Well, no. We could, if they have it, utilize a brokerage account balance or a 401k. And depending on the situation and the loan type, we take the balance in that 401k or the brokerage or the IRA and divide it. Used to be we divide it by 36, and they had to take a distribution out to show that income amount. We don't have to do that anymore. We can divide it by 36 or 84 for some loans. But the cool thing is your buyer will not have to take even a one-time distribution from any accounts. They leave the 401k intact. We're just using it as kind of a make sense component to their income. Also, the bottom line here, they do not have to be 59 years old to utilize the 401k to calculate an additional income stream. They don't have to crack the 401k balance or take any money out of it. This is really, really cool. And the rates are fine. The rates are in line with everything that you're seeing on the fully qualifying stuff that we call it. One more thing here, the flexible lending space today, 10:30 Tuesday morning. We have a call for Wings Credit Union. I finally have a credit union in Oregon. All we know so far is they'll do 5% down up to $1.5 million. I'm very hopeful that, as credit unions tend to, we'll have some strong arm products where a loan is fixed for the first 7 to 10 years at a uh, really attractive rate, lower than what I'm able to get as of Monday afternoon. Hopefully Tuesday morning's really good. I will of course get you information about that as it becomes available. Separate lender graduate program. This is kind of like a doctor loan, but it's for recent graduates who will start work within 60 days of closing on the mortgage. And what we do is we take all the student loans and just remove them from the liabilities. So it's kind of like a student loan program. We take all the payments where we don't calculate any payments for any student loans. You have to be in one of these fields here: medical, legal, engineering, architecture, accounting programs. Okay. Uh, you can close with just an offer letter and no paycheck yet, as long as the contingencies on the offer letter, such as a drug and background check, have been checked off of, and you start within 60 days of closing. So, really good stuff. I'm going to get back to you on the Wings Credit Union thing. I'm really excited about that one. And I will see you soon. Thanks.